Welcome back to the COVID-19 Comeback Series. I'm John Mitchell, and this is our third video focused on commercial borrowers. Today I'm talking to two of our lender lawyers to share their experiences, and we hope the discussion is useful to companies who are thinking about how a downturn could impact their loans from banks and other creditors. We've got Matt Cheek, who chairs the firm's financial services industry group, and Mike Mueller, chair of our restructuring and bankruptcy practice. Last time these gentlemen walked us through the mechanics of loan defaults. In today's video, we will cover how banks respond to defaults and give you a taste of that process, including the range of remedies that a lender may pursue. And that discussion will tee up a future video on restructuring and forbearance, the outcome that offers a real hope for borrowers with problematic loans. As always, our goal as counsel to banks is to demystify how banks think about defaults and help borrowers have constructive dealings with their lenders. Mike, can you start out by telling us how bankers are organized behind the scenes?
Sure, John. Thank you. Hello, everyone. Banks are organized in terms of who the borrower or customer comes in contact between relationship managers, portfolio managers, chief credit officers, special asset department or workout, and C-suite executives. Relationship managers are the borrower's or customer's main point of contact with the bank, and they assist the borrower with finding the right type of loans to fit the customer's credit needs. Portfolio managers are responsible for supporting a portfolio business within the bank and soliciting and servicing borrowers with respect to a variety of different types of commercial loans, such as real estate loans, commercial and industrial loans, asset-based loans, etc. Chief credit officers are responsible for the oversight and overall management of a bank's credit administration department to ensure the overall quality of a bank's loan portfolio, including the underwriting and loan review analysis process and loan policies and procedures. Special assets departments or workout groups handle or manage the bank's special assets. Namely, they monitor, restructure, or liquidate trouble or adversely graded loans within the bank's loan portfolio. Finally, bank executives refer to the C-suite executives such as the bank's president and chief executive officer, chief financial officer, chief operating officer, and chief credit officer. Matt, what type of actions do banks take when they're confronted with a minor default, as opposed to a major default or a more serious default?
Right. Thanks, Mike. So in prior sessions, we talked about the psychology. In prior sessions, we talked about the stair step of risk grading. We talked about the severity of the situation, the risk of loss, and so forth. And we kind of talked about it in this sort of from a standpoint of a ladder almost. And the personnel that a borrower is interfacing with also kind of can evolve along this ladder of personnel that you just mentioned. So to answer your question, at first, there will be some type of breach or violation of some provision of the loan documents. Maybe it's as obvious as a payment default. Maybe it's less obvious in the form of a performance default, for example, a breach or violation of a quarterly or annual financial performance covenant, et cetera. And so when that breach or violation occurs, step one would be for the bank, typically early on transmitted through the relationship manager, the sort of salesperson that would be the front line of communication with the borrower ordinarily, to communicate the existence of the breach or violation. This might come in the formal form of a phone call or email. It could come in the formal form of a written notice, perhaps sent to guarantors, describing the nature of the breach or the violation, and typically reserving banks' rights. So this is what we call a reservation of rights letter. So it declares that a breach or violation has occurred, and the bank reserves rights and remedies. That would be step one. Step two is that once a breach or violation occurs, a bank also has the ability to declare formally the existence of an event of default on the basis of that breach or violation. And beyond that, after the event of default, the bank has the opportunity to either accelerate or demand the loan payable in full, okay? Now, along that gradation, if you will, The bank might be thinking about early on, if it's a quote minor default, as you said, Mike, the RM with its chorus of voices standing behind him or her might say, listen, you've had a breach or a violation. We've reserved our rights and remedies, but what we're going to do this time around is we're going to waive it. We're going to give you a one-time waiver, and that's the end of it. It's a mulligan. And if that, let's say, escalates, or the situation or the risk grading or whatever is a little different, then perhaps it's a waiver coupled with a modification. So for example, maybe you'll waive this quarter's financial performance covenant, and maybe you'll modify it for the next couple of quarters because you know there's going to be depressed performance. From there, the modification might become more robust. It might not just be a waiver and a modification. There might be some additional terms added to it. And Mike, when you were talking about the personnel, I think one of the things we're trying to get across to our friends on the borrower side of the fence is that it would not be uncommon for the line of communication perhaps to start to shift away from the friendly voice of the relationship manager that the borrowers enjoyed for all these years, and to start to shift over to someone else, possibly on the credit side, or if the bank is sophisticated enough to have a special assets group, over to a special assets manager. So that relationship and the people that you're interfacing with might start to change a little bit. So Mike, that's kind of an answer to your question about a more minor occurrence or a less severe situation. So Mike, let's talk about what happens next.
Thanks, Matt. You're right. So the line of communication can shift to a special assets officer. And we talked about the reasons for that in, I think, the first video when we talked about the psychology of this. And so on a more serious default, the bank, rather than waive the default, as you referenced earlier, may decide that they want to take some formal action. And this usually takes the form of two things. One, it can be a restructuring of the loan agreement or the loan requirements or the payment requirements, or it could be a forbearance agreement. We're going to talk more specifically about forbearance agreements in the next one, but a loan restructuring refers to when the bank agrees to modify the loan terms, including the repayment terms of a defaulted or non-performing loan, with the hope of increasing the chances of loan repayment. Modified terms may include a reduced interest rate, resulting in lower payments. Conversely, sometimes you see a bank want to increase the rate to reflect the greater risk to the bank. It may extend the maturity date, again, with the idea of lowering payments or reduced amortization. Bank may waive or defer payments for a period of time. In fact, we've talked about how there's a lot of that going on right now with COVID and the interagency guidelines, allowing banks to modify or defer payment terms without declaring the loan to be what in banking parlance is called a TDR, or a troubled debt restructuring. You also may have a waiver or a reduction of those financial covenants you just referenced. In exchange, the bank may ask for some additional collateral. It may ask guarantors to ask for additional guarantors or to add guarantors, or to change a non-recourse loan to a recourse. They may ask for escrow for taxes, insurance, debt service, interest payments. They may ask for a cash management or lockbox to control cash flow. They may ask for increased oversight or additional borrower reporting. And they may ask for waiver of claims or defenses by the borrowers or guarantors. You can see a lot of those same things in a forbearance agreement, which we'll talk about in more detail next time. But the idea is to try and resuscitate the borrower that's struggling by changing the payment terms so that it's more likely that the loan will again become a performing loan and increase the likelihood of the bank's repayment. Unfortunately, sometimes that doesn't always work, and the bank's efforts and the borrower's efforts to resuscitate the struggling borrower are unsuccessful. Sometimes that can be through no fault of the borrower. It could be that the business is just obsolete. We've talked about that, where the borrower's business is just no longer relevant in today's modern economy. When that happens, the bank generally has no alternative but to pursue collection remedies, including liquidation of collateral and pursuing borrowers and guarantors for payment. For real property collateral, you hear about foreclosure all the time. That's a typical bank remedy. Or less common is you hear about where the borrower voluntarily gives the lender a deed in lieu of foreclosure and deeds the real property collateral to the lender. In foreclosure, in Virginia, we have what's called a non-judicial foreclosure state, which is convenient for lenders. It makes the process easier. But the bank's representatives, they're called trustees in the deed of trust, can foreclose on the collateral via state law rights granted in this process. The trustees, because there isn't a judicial process though, there is a strict compliance requirement for notice requirements. Foreclosures typically take 60 to 90 days in Virginia, and one of the key components is an advertisement, and that's part of the notice process. And a notice of foreclosure sale must be advertised at least once a day for 3 consecutive days or once per week for 2 weeks in a newspaper, a general circulation in the county or city where the property is located. Usually the deed of trust sets forth the advertisement procedure and notice requirements, but if no provisions are set forth in the deed of trust, the advertisement must run for once a week for 4 consecutive weeks. In addition, the lender or the trustees must send a notice of foreclosure, and a copy of the advertisement must be served on the borrower at least 14 days before the sale, and must provide a description of the property as well as the time, place, and terms of the sale. Finally, the sale cannot occur earlier than 8 days after the first advertisement and no later than 30 days after the last advertisement. I think, as people know, the trustee or the bank's agent then auctions the property to the highest bidder. There is judicial foreclosure in Virginia too. A lender can opt to go that route. And in that case, the lender files a complaint and a notice of lis pendens in the circuit court, obtains a final judgment of foreclosure from the court, and then the property is sold as part of a publicly noticed sale by the local sheriff. That deals with real property. With respect to personal property, that serves as a lender's collateral pursuant to a security agreement and typically a UCC financing statement. In that case, the lender proceeds under Article 9 of the Uniform Commercial Code, specifically Part 6 of Article 9. And Article 9 sales can be either public or private, but the overall arching theme is that the sales in all aspects must be conducted in what's called a commercially reasonable manner. That's not defined in Article 9, commercially reasonable manner, but the idea is notice. You must provide notice of the proposed sale to the borrower, the guarantors, and any other lien holders. So in that situation, what a secured lender does is he runs a lien search. There's a safe harbor provision in Article 9 that says if you run the lien search within 20 days of the sale and provide notice to all parties that have a lien of record, that's sufficient. And typically for a public sale, 10 days notice is considered per se reasonable. Anything shorter can still be reasonable, but a good rule of thumb is to give everyone at least 10 days notice. In a private sale, the secured lender goes out and it may hire someone to market the assets and find a potential buyer. And the lender will enter into terms of the sale with the prospective buyer. But again, you have to give notice to your borrower, your guarantors, and any other lien holders. In case another lien holder wants to bid more for those assets or offer more, or there's also the borrower has a right of redemption and can come in and satisfy the obligations, the whatever's due on the note, the attorney's fees and costs of sale, and redeem the collateral. That's the most common types of Article 9 secured creditor transactions. But in addition, under Article 9, Secured lenders can collect accounts receivable and other payments directly if it's part of their collateral by giving notice to the obligor directly saying, hey, in the future, direct payment to me. That's called a cutoff right notice. And once that obligor has notice from the lender that they're to pay the lender directly, they have to do that or they can be subject to double liability if they go ahead and pay the borrower. A secured lender can repossess collateral so long as they do not breach the peace, or it can retain the collateral in full or partial satisfaction of the debt with the borrower's consent. Finally, Matt, we talked a little bit last time, I believe, about judgment suits. And that's where the lender, initiates suit directly against the borrower and any other co-obligors, such as guarantors. Matt, significantly, when all else fails and a lender is exercising its collection remedies, a lot of times you'll see borrowers go for that last desperate attempt of when they believe there's a viable business there and file bankruptcy. Do you come across that frequently in your lending practice?
Right. So as part of this series, I think, Mike, you gave a great summary of all of the different enforcement and remedies and steps. We would hope that it never gets to this point. We're hoping to have this conversation around the concept of a COVID comeback, but I think it's extremely valuable just to see, the way things can go. And your outline of the different remedies is very accurate. One of the other things we're trying to impart with this series is to coach and kind of give borrower or debtor clients and friends an opportunity to think about best practices and what are healthy behaviors. One interesting behavior that pops up with some frequency is a threat to file bankruptcy. Now, I'm not a bankruptcy lawyer, Mike, you are. And you, I'm sure, could talk at great length about instances when in the cost-benefit analysis, bankruptcy is a very sensible option for a debtor. However, I see bankruptcy raised much more frequently as a threat to banks when the debtor's in trouble. And what they say is, well, things are really, really bad. You're exerting all this pressure on us. We'll just file bankruptcy. What I find is that, and I think what we want our viewers to really appreciate is that more often than not, that threat is hollow, or it doesn't really throw the bank off of its game. And that threat is hollow, particularly when a bank is well collateralized. So if, for example, the bank has a solid loan-to-value ratio on real estate or personal property collateral, the notion that a court, a bankruptcy trustee, a bankruptcy judge would be installed as basically the surrogate for the bank's workout department to see, there's a set of rules, there's a court process, there's procedures, there's priorities, they segregate the different types of creditors, and then they administer things fairly. If a secured lender is well collateralized, a secured lender doesn't really have a whole lot to fear from bankruptcy except for the time and delay. So I wanted to throw that out there just from a general marketplace perspective so that our viewers kind of heard that quite clearly. Mike, you might want to debunk that theory being a bankruptcy lawyer, but I'd just be curious. I just see it coming up in workouts a lot, and sometimes it's a sort of, I don't want to say naive threat because it sounds like I'm being condescending, but I'm not. It's a hollow threat is what I should say. Mike, what do you think about it?
I agree with you wholeheartedly, Matt. It is when a borrower is making that threat versus a legitimate reason or basis to restructure its indebtedness, it's usually a borrower that's being uncooperative with the bank anyway. And we talked in the first series about character counts when dealing with a bank. And if you're a borrower who is using that threat as some sort of leverage, you're a borrower that is not cooperating with the process typically in any event. And I'm going to welcome the bankruptcy court oversight because they're going to have reporting requirements, and they're going to have an obligation to the federal judge to supply those reporting requirements and so forth that they're not giving to me. In addition, the secured lender is entitled to adequate protection payments. So when I'm not getting payments, outside of bankruptcy for whatever reason. In bankruptcy, in order for the debtor to keep its collateral and to keep the secured lender at bay, they need to make adequate protection payments to the bank. So I'm going to start getting an income stream. There's a nuance to that if you've got a lot of equity in your property, but I'm going to start having an income stream where there wasn't one before. And I'm going to start getting information where there wasn't one before. And if you go to bankruptcy court, you're asking for extraordinary relief. And the quid pro quo of that is basically you have to come to court with and be completely transparent about your financial affairs. And you're going to file schedules listing all of your assets. You're going to file a statement of your liabilities, and you're going to be subject to questioning by the lender and other creditors, which you otherwise may not be, where I can gather information to essentially arm my quiver for when I am able to exercise my remedies. So the threat of bankruptcy actually doesn't faze me or most sophisticated lenders at all. In fact, we welcome it when there's a borrower that is being uncooperative, because that dog ain't gonna hunt in bankruptcy court.
Right. Well said.
Well, guys, I think we've come to the end of this particular video. That's a lot of great information for people to consider. And to our audience, thanks again for tuning in. We hope that you'll join us for our additional episodes. For questions about today's topic, please contact any of the panelists. The contact information is at the end of this video. And please be sure to visit williamsmullen.com. We are constantly posting new resources to help your business make your COVID comeback. Thank you again, and be well, everybody.